Hi everyone, welcome back to the US CPA classes for regulation exam. In this video of US individual taxation, we are going to cover in detail about deduction from gross income to arrive at adjusted gross income. So let's dive into to understand the deduction from gross income to arrive at AGI.
Either a standard deduction or itemized deduction, whichever is more beneficial to the taxpayer. So, like we were discussing before the break, also many a time like student get confused between what should be considered in exclusion and what should be considered in the deduction from gross income to arrive at AGI. So that is the reason we put this into the table so that it will be easy to identify the differences between these two, and accordingly when we are making computation of income, we should give the proper consideration for the respective line item. So before we went on a break, we covered all the exclusion to reach at gross income, right? So where we discuss about a majority of that would be like kind of exempt income, but some of them are part of the you can say the expense for employer, but not an income of employee kind of thing. And if you see, like we discuss about military combat, retirement payment, simple plan, health insurance premium, qualified charitable distribution, child support, child care, compensatory punitive damage, tax-free dividend, gifts about group life insurance, health saving account, healthcare flexible spending account, illness or injury benefit, interest received on state and municipal bond, life insurance received upon the death, meal and lodging expenses for office work, pension payments, prize awards, scholarship, fellowship, and then after we discuss about educational assistance and student loan which is waived off under the care act. Then we discuss about foreign income, estate of the descendant, education saving bond, adoption expenses, education saving account, parking and transportation expense, small business stock investment. And then we discuss about qualified small business stocks, employer contribution plan, and the business expense reimbursement employer. So all these things either are kind of exempt income or should not be part of the income at all. Now we will be discussing about the deduction from gross income to arrive at adjusted gross income. So first one is the alimony, right? So hope you remember this point. Also we touch base when we did our like introduction classes. So alimony, this came under the TCJ Act 2017 under the Donald Trump administration. If you remember, so Donald Trump, good guy, has like almost done 4 time divorce before like he got married with the recent wife. He was totally like screwed up with a lot of divorces. So if you see earlier, when there is an alimony which is being paid or received, it was part of the income tax return. So like what people are facing the challenge all the time, like the new spouse would charge more alimony than the previous spouse, or maybe settlement was always be considered as the previous alimony as a benchmark, so which is coming up as a wrong practice. So finally, like when Donald Trump has came into the administration, so they have come up with this TCJ Act amendment in the alimony. So earlier, before any divorce decree which is being approved before 31st December 2018, so any alimony paid by an individual to the spouse was being considered as exclusion or deductions from the gross income, and the person, the spouse who was receiving the alimony, for him or her, it was being part of the income, right? But after 31st December 2018, for any divorce decree which is being received after 31st December 2018, it is neither shown as income or nor shown as deduction in the returns of the recipient or the person who is paying. So because it has been given as a personal nature of expenditure or personal nature of income, it has nothing to do with the taxes. So that's how, like in 2018, after this amendment has been considered. But there may be possibility that you may be encountering any cases where alimony is still now received by the taxpayer or still now paid by the taxpayer for the divorce decree which is being approved before December 2018. Right? In that case of scenario, alimony paid would be part of the deductions. Ah, sorry. So, alimony paid before for the divorce degree before 31st December 2018 will still be considered in the income tax return. So it may be possible that you encounter with such cases. That is the reason this is being required for your information purpose. Second is business expenses. When there is an individual who is doing business, maybe as a sole proprietorship, right? Or maybe in a partnership firm. So in that case of scenario, he or she must provide all the business expenses detail in Schedule C. So if you remember, in the second class, I have been taken you through the all tax filing form along with the respective schedule. So, do you guys remember like all the forms which we have gone through 1040 and the related schedules? I have shared all these forms with all of you in WhatsApp group also. Have you guys downloaded those forms?
Yes, sir.
Right? So, this is like 1040 form in which when there is any business income, you need to provide the detail in Schedule C. So this is Schedule C, which go as an attachment to Form 1040. If you see here is the detail of the business nature, address, everything, and then all kind of incomes you'll be mentioning and all kind of business expenses you'll be providing the details over here, and then finally it result into the net profit or loss of the business, which and then like cost of goods sold or maybe depreciation or other expenses details will comes over here. From here the income from business will go to this form 1040. So one second now.
Sir, if you look at your left-hand corner,
Mhm.
there is mention attach forms W2 here. Also attach form W2G. What is W2G?
W2G. W2 I have seen. W2G. Let me see. One second. Mm, W2G. It's maybe like electronic form, I think so. You can go through this. This is for gambling or winning income.
Gambling winning. Okay.
Yeah, these all forms are being available on IRS website. So
Okay, sir.
anytime
Okay,
you
sir.
can take a look. So yeah, form W2G contain gambling winning basically. So if any withholding tax withhold by the casino owner, right, when they
Right,
are
right, right.
providing the like, so that will be form W2G, right? So,
Like we were discussing about short term and long term
hmm,
gain and losses, and over
hmm,
there we mentioned that deduction from
hmm,
gambling business itself.
yes. So, yeah, right. So, this forms will go as an attachment to 1040. Same way like the capital loss deduction. So, if you have any capital loss, right, that you are adjusting against the capital gain, right? So that is comes under the deduction from gross income. So one side you have capital gain, that is your income, minus if there is any capital loss you have. So that you can do net off, and that will go in schedule D. So if you see schedule D, so here, short-term capital gain or loss. So we'll be providing the detailed proceeds, sales price, cost, adjustment, final gain or loss. So it will go line by line. For some line item, it may be gain. For some line item, it may be loss. And same way for the long term also. And then there would be netting off procedure. So these all information you will be providing in Schedule D. Next is expenses of producing rent and royalty income. So for this, I think I have shared schedule E also with you. There you go, supplementary profit and loss. So here, income and loss from rental real estate property and the royalties income. So here you'll be providing all the details relating to income and related expenses which you have made, right? So this kind of detail will go as an attachment to 1040. Then after expenses for producing farming income, this is schedule F. This is also, I think I have shared with you, schedule F. So this is for farming income. So farmer like whose total revenue is less than $26 million, they can choose either cash method of accounting or accrual method of accounting. But the farmer whose income is more than $26 million, they have to follow accrual method of accounting, right? And their income and expense detail will go in this respective form, which is schedule F. So right, in this format the information will go. And if like in this particular, I would say, the form, which is like the manual, when you are filing the manual form, it is like this. So in the manual tax return, you can add an extra to it if it is all the information is not coming in this form. But when you make electronic filing, so there is an option to add the respective lines then and there. So that is available in electronic format. Next is contribution to the retirement plan, like self-employment plan, simple plan, Kellogg plan. So right hand side, we have seen contribution made by employer. That is never be part of your income, right? And here we are discussing contribution made by employee. So contribution made by employee is also being considered as a deduction from gross income. So when you are calculating your taxable income, neither the employer contribution nor the employee contribution is part of your adjusted gross income, right? And then after 50% of the self-employment tax. So self-employment tax is basically your social security and Medicare taxes, 50% of that. So as an, like when you are working, when the taxpayer is working as a sole proprietorship, right, or a partnership firm, right, in that case of scenario, that individual has to pay 50% of self-employment tax for himself or herself, or 50% of the self-employment tax is being paid by the sole proprietorship or the partnership firm. And self-employment tax is equal to the Medicare taxes and social security taxes, basically, right? So in case of sole proprietorship or in case of partnership firm only, there is a requirement for paying self-employment tax, because here you are wearing both the caps. So you are engaging yourself as employee as well as employer. So as an employee, 50% of that will go under the firm account and as an employer 50% of that will go from your individual account, right? So that deduction is also being available from gross income. Next is self-employed health insurance premium paid for self, spouse, and dependent. So, like Schedule 1, in the Schedule 1, this information will go, which is your deductions schedule. I think that we have not downloaded. Let me download that for you really quick.
So till the time you download, can you have a look on the point number 31 of exclusions? I think here it is mentioned employee contribution to retirement plans. It should be employer, I guess.
One second. Which point you're saying? 31.
In the exclusion, yeah.
Mm-hmm. Yeah.
So here it should be employer, right?
Mm.
And the employee contribution will be in the deductions, right?
Yes, yes.
Okay.
You're right. Right. So Schedule 1 quickly, let me download. I think it is this one. So additional income and adjustment to additional income. So if there is any additional income, which is like we in India we call it other income category of things, and any related expense that you can file in Schedule 1. So this also I'm downloading and share with you. Right. After the class, I'll drop into the group for your ready reference. So self-employed health insurance premium paid for self, spouse, and dependent will be provided in Schedule 1. Right. So that is the maximum deduction for health insurance premium is 7.5% of adjusted gross income. To that extent, you can consider as deduction. Right. On the other side, like this is something which is being available for itemized deduction also, right? So this is something optional. Either you can choose this as an exclusion over here, or you can choose in the itemized deduction. The limits remain the same, 7.5% of AGI. Next is health saving account contribution. So earlier we were discussing health saving account contribution by employer. Now we are discussing about health saving account contribution by employee. So up to 3850 for individual and up to 7750 for family. And to a qualified deduction, taxpayer should covered under the highly deductible health plan, not have any other health coverage plan, not enrolled in the Medicare, and should not claim as a dependent on someone else's current tax return. So these four conditions need to be made if the employee need to avail the benefit of 3850 or 7750 as the case may be for health saving account of his contribution. Employer contribution any which ways was there, but employee contribution also being considered as exclusion. Next is qualified student loan taken for self, spouse, or dependents higher education to pay their tuition fees, course fees, room boarding, books, supply, equipment, and other necessary expense. So interest up to 2,500 to all the filing status other than married filing separately, right? So other than married filing separately, all the status can claim up to $2,500 per annum for any student loan interest they are paying for the qualified education of himself, herself, spouse, dependents, right? So and it include lodging and boarding as well, right? So if you see the exclusion which we were discussing, right, there was exclusion only for tuition fees, course fees, and supplies, but here it includes the boarding expenses also, rooms and boarding expenses also. But here is a part of interest only, not the principal, right? So refer form 1098E received from the bank by taxpayer to identify the interest paid. Refer note 1 below for the phase out limit. So here two things, as a tax consultant, how do you verify how much amount has been paid as interest for this loan? Right, for that you can ask to your client, provide me form 1098E from your banker, right? And there is a phase out limit for it that we'll be discussing below. Clear? So far so good. Next is qualified higher education expenses. So there are certain limit which we'll be discussing in when we study like tax credit, educational tax credit. So there are certain expenses up to which for the higher education for yourself, your spouse, and the children's can be made, and that can be considered as exclusion from or deduction to arrive at adjusted gross income. Next is up to $300 or $600 for married filing jointly, a cash contribution to a qualified charity. Non-itemized only, use either in deduction of gross income or itemized deduction, not both, when standard deduction option is selected. So here what they are saying, when you are making a cash contribution to a qualified charitable institution, right? So cash contribution up to $300 you can make as individual, or $600 for married for joint return, right? But more than that, if you want to make any contribution, so you should have a proper documentation and it has to be route through the bank. So cash contribution you can make maximum $300 or jointly $600, but beyond that it should not be in cash. It should be through the bank, right? Or it should be, if it is a property, then fair market value of the property. One thing is that. Second is, this contribution to the qualified charitable institution is also being eligible for itemized deduction. So when we come to the itemized deduction, we'll be discussing that. So, in terms of deduction, first, if you remember, it's a income minus, or you can say reduction of the exclusion. And from exclusion, you will be further minusing this deduction to arrive at adjusted gross income. And from the adjusted gross income, you have to choose either the standard deduction or itemized deduction, whichever is more beneficial to the taxpayer. That means there may be a possibility sometimes standard deduction is more beneficial, or there may be a possibility that itemized deduction is more beneficial for taxpayer. When you are choosing standard deduction, right, which is being more beneficial to the taxpayer, then as a tax consultant, we should recommend to our client to go for this charitable contribution deduction, right? So that means you will get the benefit of standard deduction, which is after the adjusted gross income, but before the adjusted gross income, you can avail the benefit of the contribution which you have made. So that can be a good tax advice to any of your client. Clear? Or any doubt here?
No, sir.
Right. Next is interest on forfeited bank on premature withdrawal. So sometime when you do premature withdrawal, that means you have done any deposit. Like if you remember, we discussed this in US. There are two type of bank account: checking account and saving account. Do you remember that?
Yes,
Yes,
sir.
sir.
Yes, sir.
Yeah. What is checking account?
So
To
there's
meet
a
all your expenses, everything day to day.
Yeah. So where you make day-to-day transaction, right? And what
Mm.
is saving account?
So where you're transferring the money on a monthly basis, maybe to save.
so
Yeah.
other differences on saving account you get interest, but
Hmm.
in
Yeah.
checking account you don't get interest.
Yes, very true. So, saving account is for depositing money to earn the interest, whereas checking account to manage and operate your regular business, right? So when you are depositing money into your saving account, for example, it's a 6 month deposit, 9 months deposit, 12 month deposit. So you are expecting you have deposit something for 12 months. So after 12 months, you might be receiving 4% as a interest. So today, if you have deposited $100,000, so after 1 year, you can expect to receive $104,000, right? So very simple, straightforward. On the other side, if you have done, if you are in need of money and you have done the withdrawal of this cash, right, before the 5 year of the maturity time of the respective bond or maybe respective asset. So in that case of scenario, you may be liable to pay certain penalty or you may be liable to pay certain taxes, right? So that is called premature withdrawal, right? Charges for premature withdrawal. So in that case of scenario, the interest and taxes which you are paying, you can consider that as an deduction. Make sense?
Yes, sir.
Next is educator expense. So this is kind of special category of expense. This is for K-12. That means schools professor, schools teacher basically. So like when you are teaching in school, so you may invest a lot of personal money in purchasing the stationery, pen, pencil, notebook, drawing, so on and so forth, right? So for that, there is an educator expense up to $300 per person is being eligible. That means $300 without providing any supporting or bill in a year, you can claim as deduction, right? But the condition is that you must be working in any school for more than 900 hours in a year, right? The taxpayer should work in a school at least for 900 hours in a year. Clear?
Okay, sir.
Yes or no?
Yes, sir. Yes, sir.
Hmm.
Yes, sir.
So next is I think interest on forfeiture of bank on premature withdrawal or the penalty for early withdrawal go hand in hand, which we have discussed. The last one is other health coverage. When taxpayer is not covered by any HDHP like highly deductible healthcare plan coverage, then he or she can make a contribution to the other health coverage account and that can be considered as a deduction, right? So with this we are covered, we are done with the exclusion and deduction to arrive at AGI. So I'm still again reiterating on this computation of income because like exam time also you may have such confusion. So that is the reason I'm reiterating again on the same point because in past I have experienced many students get confused in these two. These two are not same, these two are different, and this comes into point number 2 and point number 3 here. So your total income, then first we discuss before the break all the exclusion, then after the break we have covered the deduction from gross income to arrive at adjusted gross income. That means so far we have studied all category of income, we have studied all category of exclusion, and we have studied all category of deductions to arrive at AGI. That means we have reached to adjusted gross income, right? So now we will be learning itemized deduction or standard deduction, right? So we'll be going on to the fourth point. So far, so good in terms of computation,
Yes, sir.
right? So in this logical flow, we'll be understanding each topic. One second. Okay. Yeah. So there was one topic, like we discussed about phase out, right? So this we have, like the phase out of student interest loan, which we were discussing, that refer note 1 below somewhere we have mentioned. So first thing is phase out. Do you remember we discussed this phase out? limits. We discuss about the concept of phase out. Any idea what is phase out?
No, sir.
Okay. Have you guys heard about Robin Hood rule? Do you know like Robin Hood was a film star in US? Any
Yeah,
idea?
who
So what?
steal from rich and
Yeah, yeah,
distribute to the poor.
yeah. So who steal like money from the rich people and distribute to the poor people, basically, right? So, like the tax laws, whether it's like in India or maybe US or most of the country, they follow the same rule. Like when your income is low, you should be paying less taxes. But slowly, gradually, when your income start increasing, so you pay more taxes. And once you reach to the, like ultra rich, you can say category, so you'll be paying most of the taxes, right? So in India, we call it like slab rate. In US, we call it marginal tax rate, right? So in US, the new terminology which is being used, which does not exist in India, is the phase out, right? So phase out is basically up to certain level of income. You'll get all the benefits of deductions as well as tax credit, which we are going to study in future. But as slowly and gradually your income will start increasing, you'll get your benefits, your deductions as well as your tax credit will slightly start going down. And after a certain threshold amount, so you'll not be eligible for those deductions or tax credits. So that is called a phase out, fundamental phase out, you can say, mechanism, right? So this phase out mechanism is being used majorly for almost all the deductions as well as almost for all the tax credit. So it means when your income is lower, you will be eligible for maximum deduction. But when your income reach to the peak, right, at the high, at that point of time, you'll get less and less tax deductions or less and less tax credit. So that is what called phase out limits or phase out mechanism, right? So here the student loan interest which we were discussing about $2,500, right? So what they're saying, if the taxpayer filing status is single, head of the household or qualified widow, right? And adjusted gross income is not more than 7,500, right? So then there is no effect on the of the phase out. That means entire $2,500 you can claim as a deduction. Hmm? When the taxpayer income increase from $7,500, but it's still less than $90,000. That means up to additional $15,000. So at each dollar, you'll be reducing proportionate tax benefit. So that is called phase out. Maybe we'll do a small illustration for this. Don't worry. And if your income is more than $90,000, adjusted gross income is more than $90,000, then you are not eligible for any student loan interest deduction of 2,500, which we have discussed above. In case of married filing jointly, so the limits increase. So up to $150,000, you'll be eligible for entire $2,500 deduction. When your income, joint income, increase from $150,000 to $180,000, per dollar increase in income, there is a reduction in the corresponding deduction. If your income is more than $180,000, you are not eligible for any deduction. So then it will be not available to you. So maybe we can do a small illustration for this. Let me take you back to the Excel sheet. So here, like please look at carefully about this phase out limits, because this phase out mechanism or method is being used almost in all deductions as well as tax credit. Right. So here, if you see, let me take you back. Student loan interest, if you remember, that is 2,500. Yeah, so qualified student loan taken for the spouse dependent higher education supplies interest up to $2,500 for all filing status other than merit filing separately, right? So student loan interest, let's assume you have $2,500 total student loan interest, right? And you're married filing jointly, and married filing jointly, AGI, adjusted gross income. Scenario 1, 2, and 3. Right. So married filing jointly, if you see in the phase out limit, the limit is $150,000, $180,000, or 180 and above. Right. So let's assume you have total income of $100,000 and you have total income of, let's assume, $165,000 and you have total income of $200,000, right? So everyone so far with me? So how much is the student loan interest is being eligible for deduction? Right. So in the first scenario, the total income is below $150,000.
Right.
So you'll be eligible for entire $2,500. Right. In second case of scenario, your income is more than $150,000 but less than $180,000. Right. So how much is more? Plus 165 minus 15123 4, right? 15,000 is more, right? So in this case of scenario, the phase out limit is between 180 to 150. That is $30,000. Clear? Right? So the phase out room is $30,000. That means 2,500 divided by $30,000. That means at every increase of $1 in income will result into 8 cents reduction in the student loan, right? So that means every $1 increase in income result into 8-cent reduction in the student loan interest, right? So the total increase was $15,000. So how much we will be reducing this multiplied by 8 cents. That means 1250 will be reducing. So the total benefit will be 2,500 minus 1250, right? So in scenario 2, the student loan interest which is eligible for deduction will be 1,250. Make sense? And this one is more than 180,000. So hence here is 0. Right? So this is how the phase out limit calculation will actually work. And you will definitely get good number of question on the phase out limit because this formula will be uniformly applicable to all the phase out limits, right? First, you need to identify the phase out range, and then second, you need to identify what is the total amount, and then you need to calculate at per dollar phase out how much is the on per dollar increase in limit, how much cents or dollar is the phase out, and then you should multiply with the actual number of change, right? This will definitely come to your exam, right? So you should be very careful about this calculation. So far so good. Let's do a question. There are 2 questions, we can do it together. Which of the following changes must a taxpayer report to the marketplace when enrolling in when e-rolling, I think it should be enrolling. Let me see. E-rolling in the health coverage of or during the health coverage during the year. I think there is some typo error in this question.
So it's saying re-enrolling.
Yeah,
Re,
re-enroll.
yeah, re-enrolling. Sorry. That means you are already there. So which
Yeah,
of the following changes must a taxpayer report to a marketplace when re-enrolling in health coverage?
I think point number two, changes in marital status. Other
Yeah,
than that,
that is fine, but I'm still at question. So why this or is required here? Enrolling during the year should be fine, right?
Re-enrolling in the healthcare during the year. That's it.
Right? This or is not required, right?
Yeah.
right?
There might be typo error. So, which of the following changes must a taxpayer report to the marketplace when re-enrolling in health coverage during the year? First is change in household income. Second is change in marital status. Third is change in employment. All the responses are correct. So, which option is correct?
So change in marital status,
Why?
That's reported.
because you want to cover your spouse
In the
into the
joint
same
return.
plan.
Yeah,
Yeah.
yeah, very true. So maybe like if you are getting married or the taxpayer is getting married, then it may be joint return, or if they are getting separate, then it may be single return, right?
Right.
So
Right.
accordingly, like the phase out limit will change. Next is Jim filed his tax return as a married filing separately. He has not lived with his wife for 2 years. In the tax year 2023, by court order, he paid $500 per month as a separate maintenance and $200 per month as a child support. What amount can Jim deduct as alimony expense? So, when this court has approved the divorce decree, 2023,
Yes, sir.
right? So after 31st December 2018, any divorce degree, so alimony is neither considered as income nor expense, right?
Expense. Yeah.
Right.
So call of the question here is what amount can Jim deduct as alimony? So answer should be
0.
zero. Make sense?
Yes.
So second option for that.
Excuse me, sir. In
Mm,
this
mm,
question, it is not mentioned that he got divorced. Question says the court order to provide maintenance for his spouse as well as
mm,
for child support.
mm,
The question is not saying that he got a degree on
mm,
divorce. It's maybe
mm,
he is staying separately, but is not maintaining or
mm,
providing support to
mm.
his
Yeah,
spouse and for a child.
yeah. No, very, very
So
good point.
alimony is not applicable here itself.
Yeah, so two things here, like one is, Rakesh, you pointed out very well, it is not clearly mentioned about the divorce degree here. But on the other side, if you look at the question, so Jim filed his tax return as a married filing separately.
Yeah.
That means
So he's married,
he is
and but
still married. He has not
yeah,
received the divorce degree, right? That's very valid point you observe. And he has not lived with his wife for 2 years. In the tax year 2023, by court, he paid her $500 per month as a separate maintenance expense and $200 per month as a child support. So maintenance expense and child support were is not part of alimony. So it's a
yeah,
maintenance charges, right?
yes,
So last line, if you see the call of the question is what amount can Jim deduct as alimony? So maintenance expense are not part of alimony, right? So that's the right interpretation. Thanks for correcting, Rakesh.
yeah.
Right, everyone got this point? Yes, no, at least respond. Okay, so next topic is very simple. I think all of us have studied in our school days or college days about the accounting period and accounting method, right? So accounting period, normally for individual, it's considered as Jan to December as a calendar period. However, like taxpayer can choose to have 52 weeks, 53 weeks, or maybe different accounting period as well, right? So that is not an issue, but the taxpayer has to provide the detail in the form 1040 when they are filing, that what is the tax year they are considering. So if you go to this 1040, so here they are for the year Jan to December or other tax year. So you need to mention here. Make sense?
Yes.
Hmm? So the taxpayer should make an election of the tax year at the initial tax return filing, right? When you are making your first income tax return, at that point of time, you should take the decision what will be your tax year. An IRS approval is required if taxpayer wishes to change the tax year in future period by filing a form 1128. That means first time when you are filing your tax return, you can choose what should be your tax year. But later on, if you wanted to make the change, then you need to file a form 1128. Clear? So if you see, this applies to all, whether it's like individual or maybe the C corporation or S corporation, right? So I was auditing, like there are many company in US who follow 52 weeks as a year. Like I was auditing Intel. So Intel follow 52 weeks. Palo Alto Network, they also follow 52 weeks. I think Oracle, they are also follow 52 weeks. Apple also follow 52 weeks a year. So, there are many companies in US who follow 52 weeks or 53 weeks a year as well, instead of Jan to December. And there are many companies like Amazon, they follow October to September as their tax period also. So that is also being permissible. So again, like point is that at the inception, when you are filing your first tax return, so you should consider what is your tax year and you should be consistent for that. But if you are making any change, you have to file form 1128. Right? So far, so good? Yes, no.
Yes, sir. Yes, sir.
So, any specific reason why these companies do that? Because my organization also following November to October.
Hmm. I would say two things. One is they do like internal MIS or reporting on a weekly basis, and second, like with the 52 weeks, it's being more consistent in terms of number of days, right? On the
Right.
other side, when you see, like the company, like for example, Amazon, they follow like October to September period, as well as like Apple also follow October to September. If you see, like every year they launch in the first week or second week of October new product, because
Right.
their financial year, their tax year is October to September. So for them it's a new edition kind of thing. So according to their business plan, they see like their new year or their most of the sales or their new product launch, like their
Seasonality.
strategy is October, and which is like start of the festival season, which they believe they have like new launches as well as new sales would be coming up. So it's according to their business to business, I would say so.
Okay.
And or maybe like for example, let's assume like after a couple of years you move to US and you have your business here in India, right? In India, all your business follow tax year, which is April to March, right? And you do not have any specific or dedicated business in US, but there you do all business development, all execution part is being done in India, right? So then you will prefer to follow like April to March
Right.
next year for them, right?
Right.
So rather than having again and again audit or other administrative work, so you'll prefer to do that. So it's again like based on business to business. Okay. So now the most you can say interesting, or I would say basic topic, method of accounting, right? I'm sure all of you have studied in your school days Cash method of accounting, accrual method of accounting, hybrid method of accounting. Any idea? Anything you still remember? What is cash method of accounting? If
But
any of
recording everything,
mm-hmm.
recording the income or expense based on the spending or receiving the income.
Mm-hmm. Yeah. Anything else anyone would like to add?
Only when real cash transaction happens,
Mm-hmm.
and only they consider it as when they receive as an income, and when they spend, it is considered an expense.
Yeah.
They
Yeah.
don't follow accrual. They don't
Mm-hmm.
record accruals.
Yeah. They don't accrued.
Yeah.
Mm-hmm. Yeah. Very true.
So
Very true.
it's on the real time basis. When
Very.
cash received, it is considered as an income, and when payment is done, it is
Mm-hmm.
considered an expense.
Yeah, very true. So, like in US, for, like individuals, I would say, and for the small businesses, all the options are available for tax purposes, right? So they can follow cash method of accounting, they can follow accrual method of accounting, or they can follow hybrid method of accounting. But whatever the method they choose, they need to follow consistently. So if there is any change in method, they have to take a approval from IRS. That is very first principle. Cash method of accounting, like most of you, both of you have said, is absolutely right. So, like you record all the expenses when you make the respective payments, right? And you record the income when you actually receive the money, right? So, and you do not book your accrued expenses. You do not book the prepaid expenses. You do not book any advance income. So those all things are not exist in a cash method of accounting, right? On the other side, accrual method of accounting.
So, sir,
Do-
advance income is also been considered. So they
yeah,
don't follow period accounting.
yes,
They
yes,
follow
yes.
the real time scenario.
Real time accounting,
So
absolutely.
even if they receive income in advance, they'll
Hmm.
consider it as an income.
Yes, yes, yes. The money it's coming in bank account, it's being income, and money which is going out of the bank account is expenses, right? When you are following cash method of accounting. So, do you remember what is accrual method of accounting?
So accrual based, it's follow the concept of period.
Yeah.
So uh, they record transaction irrespective of when actually realized or actually paid, but for
Mm-hmm.
which period it was related to. So
Mm-hmm.
similarly, taking example of insurance, we pay in India, basically we pay in advance,
Mm-hmm.
and then we amortize in as a prepaid form
Yeah.
of journal.
Mm-hmm.
Similarly, when we anticipate any expense in future, we
Mm-hmm.
accrue them. I'm going to make it payment. Like take an example for salary. Even in India, when the salary got paid in the next month or first week, but it is related to previous period, the record
Mm-hmm.
is an accrual. So
Yeah.
when accounting is done based on period,
Mm-hmm.
it is being followed for accrual methods.
Yeah. Yeah. Anyone else would like to add something? Prakash, Kimudin, Sukhwinder, Daniel, Yogender, Manoj, anything you guys would like to add? In virtual class, it's very difficult. Yeah, no, more or less, you're right. So I'll just slightly more elaborate onto it. So accrual basis of accounting is, like when you recognize the revenue when ownership has been transferred, product and services has been delivered to the client, whether the money has been received or not. Same way, you book the expenses when you have received the product and services, whether you have actually made the payment or not. And here, like you charge like depreciation also, you record account receivable, account payables, or prepaids as well, right? Advances as well. So the accrual method of accounting follow, yes, the expenses follow the period, and as well as the income follow the period method of accounting, right? And hybrid method is kind of mix of both cash method of accounting and result accrual method of accounting. So, a hybrid method, you may recognize your income and expenses on cash basis, but At the period end, you may record your receivable and payable. You may record your depreciations. You may record your inventories also, in addition to like cash basis of accounting. So hybrid is kind of mix of cash method of accounting and accrual method of accounting. For tax purposes, it's all method of accounting are being allowed for the individual. But like there are specific provision like for businesses or various category of businesses. So there are certain amount limit. If like if their turnover is more than that amount limit, then they need to follow the accrual method of accounting. Otherwise, for small businesses and for the individual, all method of accountings are acceptable for tax purposes, right? So left hand side, first quickly look at cash method of accounting. So commonly used by the individual and many small businesses. Under the cash method, report the income when actually or constructively received. And constructive receive means income credit to an account or made available without restriction, even if not in the possession. If someone received the income as your agent and you are considered to have received it, so that is called constructively received. An income not constructively received if the control is subject to substantial restriction or limitation. So if you have, like escrow account, if you might have heard of, do you know what is escrow account by any chance?
Uh, Sorry, again, a kind of insurance account where fund is there
Hmm.
to assure that the party who has given to you
Yeah.
amount,
Upon
it is
the
secured,
completion of your responsibility.
you will get it,
Yes,
and
yes.
it is a
So
security. Yeah.
yeah, so this is what like fourth point here. Income not considered to be constructively received if the amount is parked with certain restriction or limitation, maybe in escrow account, right? Expense are recorded when cash is paid to vendor for purchase of product and services. So example here is a bank credit and make available interest to a taxpayer bank account on December 22. The taxpayer does not withdraw it or enter it into their books until 2023. So result in above situation, the taxpayer must include the amount of the gross income for 2022, not 2023, because that is the year they constructively receive the interest income, right? So for example, like normally at year end, so bank credit your interest, right? This is the example of that, which you have not yet recorded in your books, but this is being part of your the previous income and you have already received it. So in a cash method of accounting, you can consider that as your income for that particular year. Accrual method of accounting method where income and expense are recognized when they are earned or incurred, regardless of when the cash is received or paid, like we were discussing earlier. Recognize transaction when the obligation arises or the revenue is earned, providing a more accurate picture of the financial performance. When you follow accrual method of accounting, it provides more clear picture of the financial performance. Commonly used by the large businesses and the corporation as well as entity that sell on a credit or have a complex financial arrangement. So this is being, like accrual method of accounting, like we were discussing earlier, is being used by the large businesses and the corporation as well as the entity that sells on credit or have a complex financial arrangement. And it provide a better matching concept of revenue and expense, allowing the business to track their financial performance over the time and require careful record keeping and tracking of the account receivable and account payable. And if dealing with merchandise, accrual method is usually required. Accrual method is generally required for sale and cost of goods sold if inventories are an income producing factor and the taxpayer average gross receipt equal to or exceed $29 million, like I was telling you earlier. So if for any individual or for any businesses the total revenue is more than $29 million, they have to follow accrual method of accounting, right? And for the farmer, it is $26 million, right? So example here is a taxpayer is on a calendar year accrual basis of accounting, the taxpayer sold a computer on December 27, 2022 and billed the customer in the first week of January 2023, but did not receive payment until February 2023. When does taxpayer include the amount in income? 22 or 23? Just look at this example. A taxpayer who follow the calendar year on accrual basis. The taxpayer has sold the computer on December 27, 2022, right? And then he has billed in January and till February he has not received the money yet. So in which year he or she should we consider this as a revenue?
Yeah, they should book it.
2022, sir.
Yeah,
Right?
2022.
2022. So in this
So
example,
there is one issue here.
mhm,
Since he's following accrual based of bookkeeping, but
mhm,
actual invoice he raised in month of January.
mhm.
So if he was following the accrual system, then he should have raised invoice in December itself,
Yeah,
not
that's
in
a
Yeah,
January.
that's a control failure, I would say. But
yes.
the income will be relating to 2022. So as an auditor, you should give this observation of the failure of control that ideally invoice should have been raised in 2022 itself.
Raised it.
And the
Right.
second
Mhm,
issue is, as an auditor,
mhm,
since he's following book of on accrual basis, we will not be sure whether he has received the payment in 2002 or he will receive the payment, like he said, payment received in February 2023.
mhm,
So the invoice is recorded in January and in payment received in February. So
mhm.
when the book was closed in December, we don't have a confirmation whether the sale made in December.
No,
The
you have
only proof will be after we
mhm,
look at the
mhm,
inventory,
mhm,
then only we will be able to make sure that inventory is moved out without
uh-huh.
recording an invoice.
No, there would be like three, four things. One is like the shipment detail will be there, and maybe courier or shipment bill will be there, or purchase order will be there from customer. This acknowledgement of the material from the customer. There are other ways also to identify as an auditor. And then about the collection. So if, for example, if you are completing your audit on 31st January, so you can take the confirmation from the customer as well.
Okay.
So there are various way when you get into audit, but that we will discuss in the audit section of
Sure.
examination, right? So just for right in this example, the income should record in 2022. Now coming to the hybrid. So taxpayer can use combination of cash and accrual and a special method called hybrid method of accounting if it reflects income clearly and consistently. So more important is consistently or clearly representation of income and expenses. So restrictions applies if inventory is involved, then accrual method required for purchase and sale. That means if inventory is the backbone of the business, right, then he or she has to follow accrual method for inventory. Then that means purchase, sales, and inventory need to be recorded on accrual basis. Cash method for income must match the cash method for expenses. Accrual method for expense must match to the accrual method of income. Any combination involved cash method is treated as cash method. That means when you are involving cash and accrual mixed together, so it is you need to follow the cash method of accounting for that particular transaction. And different accounting method can be used for business and a personal item. So it is possible that for business purpose you might be using accrual method of accounting, and for personal purposes, personal item related, you may follow cash method of accounting. That is permissible. Separate and distinct business can have different accounting method. Here is good thing. For example, you have two, three, four businesses, right? It is possible that one business you might be following accrual method of accounting, and other businesses might be small where you follow cash method of accounting. So then that is also permissible. So that is also comes under from individual point of view, it comes under the hybrid, right? For example, you are an individual, right? You work for real estate, right? So where you follow cash method of accounting, and you also have some small business of trading where you follow accrual method of accounting, and you also earn certain incomes from, you can say, car rental, right? For that you follow cash method of accounting. Now you are filing 1040 for your individual, right? Even though for car rental and for the real estate you follow cash method of accounting, and for your business income, which is like schedule C income, so there you follow accrual method of accounting. That is permissible. Make sense?
Yes.
Hmm? If the same taxpayer owns separate businesses, different method can be used if separate accounting records are maintained for each. So this is very important, right? Another thing, like if you remember when we were studying the residential status, right? At that point of time, we touch base one point. You can file a joint return if the different spouse are follow different accounting method. But you cannot file a joint return if there is a difference in accounting period, right? So here also, if you have different businesses and the different businesses follow different accounting period, so then you need to reach to the conclusion how you can consolidate and make sure like all businesses follow the same period for filing your tax return, right? That is the reason if you see many US companies, they have subsidiaries here in India, right? But for US tax purpose and US consolidation purpose, those subsidiary company follow Jan to December or the respective period, right? So additional work is being required if you have like different businesses following different accounting period. Make sense? So example over here is a restaurant using hybrid accounting may choose to report sale on accrual basis and food purchase on cash basis of accounting. A taxpayer engaged in more than one trade or business are allowed to use different method of accounting for each trade or business. IRS consent is required to change a method of accounting, and that is amended under TCJ Act 2017 as allowed to auto consent with self-declaration from taxpayer. So earlier IRS consent was required in writing, but now with the self-declaration it is allowed after the TCJ Act 2017. Right? So any doubt on different method of accounting? Clear everyone?
Yes, sir.
Yes,
Right?
sir.
So I think this is sufficient for today because next topic is slightly bigger, which we may start in the next class. Today we have finished, like all categories of income, and we have discussed all exclusion and deductions to arrive at adjusted gross income. Then we have discussed this small topic, accounting period and accounting methods, right? So next class we'll be starting with the reporting of item through pass-through entity, which is S corporation and partnership firm. After that, we'll be covering adjustment and deductions, so which is like the next phase. Like by completing this S corporation and partnership firm topic, so we'll reach to the adjusted gross income. So from the adjusted gross income, then we jump into the itemized deduction or standard deduction. So next week we'll finish off both deduction, itemized deduction and standard deduction, and then I think it may take probably one more week for tax credit. There are 13 tax credit, so maybe like in 2 class we'll finish those, and then we'll come to the tax planning part of it, right? So I think this is
Sir,
sufficient. Mm-hmm.
sir, 2 minutes. Can you, sir,
Mm-hmm.
explain again section 1230, 45, and 1250 and 291 concept again?
Which one?
I'm
Sorry.
not able to distinguish for 1230, 1245, 1250, and 291
Oh, 1231.
for depreciable. Yeah.
Yeah, yeah. So
Still,
1231.
there is a confusion why, yeah, why and when we consider 1230, then why and when we
Mm-hmm.
can consider 1245.
Yeah, yeah, yeah.
At
So
least for
yeah.
291, it is easy, it is
Mm-hmm.
for corporation only. But these
Mm-hmm.
three, it is a
Oh, yeah, yeah.
little
I,
confusing
I
to
I
investigate.
understood. I understood your point. So 1231 is the umbrella section under which, when you are following 1231, you have to follow 1245, 1250 and 291 provision. So these four sections need to be studied together in future whenever you are studying, and when you are evaluating the respective taxes, you need to consider this together, right? So section 1231 is being applicable to all business assets, right, which include real assets as well as personal assets, right? So real
Right.
assets are land or anything which is permanently attached to the land or anything which is
Yes, sir.
growing over the land, right? That is called
Correct, sir.
real property. Personal property is other than real property used for businesses purpose. That is all movable property, right? Your machinery, plant, equipment, computers, laptops, or maybe your cars and everything, right? So 1245. So before jumping into that, 1231 is applicable to all properties which are depreciable property used for the business for more than 1 year, right? Right.
Right.
So that is 1231, which is being used for any business property which is being used for the business for more than 1 year. So under this, there is a provision of section 1245. 1245 deal with only real property, right? So 1245 deal only with real property, whereas 1250 and 1291, they are being dealt with personal property. Personal property is movable property,
Movable.
right? So for all real property, when you are when you are looking at from 1231 point of view, you need to consider 1245 along with it, right? When
Okay.
you are considering any personal property, if that personal property is relating to individual, if that personal property is relating to individual, then along with section 1231, you need to follow section 1250, right? If the personal property is relating to the C corporation, right? In that case of scenario, along with 1231, you need to follow section 291.
One.
Clear?
Right.
Right? So
Okay,
far,
sir.
so good, right?
Sure,
So,
sure, sure.
yeah. So
In
now
in
this, for one
in
second, let
I
me,
okay, okay, sorry. Sorry, sir,
yeah, yeah.
continue.
Please ask your question.
So in 1245, we
Hmm.
were looking at personal property but used less than 1 year.
Mm-hmm. Use less than 1 year mean?
It's not completed 1 year into the business.
One second. One second. 1, 2, 3, 1. This chart you're saying?
Yes, sir.
Hmm.